Hello guys, welcome to another video. I'm Adi from Pixel Profits, and this is video 9 in my series on market structure. In this one, I'm going to talk to you about liquidity concepts. Liquidity is not only an area that might draw price towards it, but it can also be an area where price reacts from. So it's worth having an understanding of some of the basics of liquidity. So I'm going to go over those in this video. So what is liquidity? What does it really mean? Well, liquidity basically means that how easy is it to buy into or sell into a market without significantly affecting the price? In an illiquid market, you might have to wait for some time for your order to be filled. An example of this would be a small cap stock. Illiquid markets are often gappy and or filled with imbalances, because for orders to get filled, price must seek out the next available order on the opposite side. So if you want to buy and there are no sellers near your price, you either have to choose to raise your bid significantly to get filled, or the seller must offer a much lower price in order to sell to you at the level that you're waiting at. Now this could be quite some way away from the last order that was executed, or in other words, far away from the current price. Because in an illiquid market, there are not enough participants to offer orders at all price levels, and therefore buyers and sellers need to move further away from current prices for their orders to be matched together. In a liquid market, there are multiple orders being offered at all price levels at all times. But liquidity is always being sought after and taken by the market, and in liquid markets, it's everywhere and it's all over the chart. So as I've previously mentioned in my internal to external liquidity video, liquidity does provide fuel for moves, and it can act as a draw on price because price is normally doing one of four things, which are seeking out liquidity, generating liquidity, rebalancing imbalances, and returning to equilibrium or fair price. And for me personally, I tend to narrow down my focus when it comes to liquidity to only consider external liquidity in the forms of obvious highs and lows, and internal liquidity in the form of imbalances and order blocks. But there are definitely areas where we can often see stronger reactions from when price reaches them, where there seems to be more resting liquidity, and that's what we're going to look at in this video. So where is this liquidity found? Well, let's start by looking at some structural liquidity points. So on the chart here we can see some different types of liquidity. We can see trendline liquidity, which is sometimes referred to as smooth edges or sometimes even support and resistance. And basically liquidity is being built up below the swing lows on this uptrend here, or above the swing highs in this downtrend. And then price might reach up into the liquidity in order to fuel the move or the continuation downwards. Or in this case, it reaches below into all this liquidity here, and then it moves upwards. So high resistance liquidity and low resistance liquidity are two concepts that we can look at quickly. Low resistance liquidity is generally in a bunch of failure swings where price has failed to be pushed lower by this high. So it's created a higher low, and then we've created another higher low. And so this is what we class as low resistance liquidity, which is basically failure to swing lower. High resistance liquidity over here is where we've taken out a bunch of highs and then we make a move downwards. Now when we come back up, we expect that there's some sort of chance that this might hold because it's been able to take all that liquidity already and push lower. So there's nothing really left up here to be taken. But these are not perfect concepts. They're just a sort of guideline that you can implement if you want to. So that brings us on to relative equal highs. Now, you can either have exactly equal highs or you can have roughly equal highs where it's similar, it's building across some kind of range most often in this case. And so there's liquidity being built on both sides of the range. And what sometimes happens is that price comes up, takes out all these previous relative equal highs, and then uses that fuel to drop down. And likewise on the bullish example here, we've got relatively equal lows. I mean, it doesn't have to be like this. It could be here or something. Price comes down, takes it out, and goes up. So exactly equal or relatively equal, i.e. almost equal, is what we're talking about in these examples. And then we have basically beyond any sort of swing or pivot point, there's going to be liquidity resting, because people are either going to go long or short in these areas. And so there's going to be liquidity with stop losses resting underneath these. And it's the same thing, same principles here and here, right? So a lot of these formations here that we just talked about fit into the category of common retail technical analysis candlestick patterns, like double tops, triple tops, wedges, flags, pennants, all that stuff. But we don't go into that too much here right now because I don't view the market in that context and I don't use those. Now, two terms to be familiar with are buy-side liquidity and sell-side liquidity. And that's very simple to understand. Buy-side liquidity is basically the liquidity that rests above the price, and sell-side liquidity is basically the liquidity that rests below the price. And there really is nothing more to it than that. So if you hear those terms buy-side and sell-side, buy-side is up on the highs and sell-side is down on the lows. That's really all you need to know about that. So let's talk a little bit about some of the mechanics that actually happen in these diagrams to give you a bit more context. So let's take the example of the relatively equal highs here. So above a high, people who are looking to go short will often have a stop loss above a swing high. So let's draw that out. So let's say they're looking to go short there and they have some sort of stop loss up here. So these stop losses, if you understand how a stop loss, going short works, basically the stop loss here is a buy order, because when it's hit, these people who have gone short are forced to buy back the asset at a higher price, and therefore they lose money. So you could say they're being forced to buy at a premium price, which is of course the opposite of what we want to do, because you want to buy at cheap prices and sell at expensive prices, right? And what about a breakout trader, for example? Well, a breakout trader might set up an order above these highs, and they might believe the price is going to go up. And so they set themselves a buy stop order above price, okay? And that's what tags them into the market as price appears to break out and move higher. So their stop loss will be below these highs, somewhere down here, let's say. So if price moves up now and takes out the high, short sellers are going to get stopped out. Their stops are going to get triggered, while breakout traders will be triggered into the market through their buy stops. And of course, we could also have limit orders in here with people putting limit orders in as well. So all of this is happening then at premium prices. So if I'm a big player and I want to sell at premium prices, then this might be a good area to do that, right? Because if I sell into this area, eventually price will start to be pushed down as the number of buyers in here starts to weaken because I've taken out all these orders. And then the price might start to drop. And when it does, what do we have lower down? Well, we have these stop losses of the breakout traders. So as these start to get triggered, this accelerates the price decline, as there are now people selling their positions at a loss before price drops too much further down. This is just a basic and simplified example just to give you a possible scenario of how things might play out. With millions of orders all over the place, it's hard to really simplify it down to such a basic explanation, and there's a lot more moving parts and complexity to it than what I've just described. But I just want to give you a very basic overview of how these price movements might be happening. So essentially what we're saying is that there is liquidity or fuel for the market resting at certain places in a higher concentration than others. And these are some examples of where you might find this and why it might be happening. Some people might call this, for example, a stop hunt, and it's just really obvious levels where orders are resting. So these kind of retail patterns like double tops, wedges, all that stuff often go wrong because of context. Because if you just simply look at a pattern and you're trading based only on that, it just isn't enough. And this applies to all patterns on a chart. When things like double tops fail, people often say that their stop loss has been hunted. And what's really happening is that they have been manipulated into entering the market on the wrong side of things. And this is often referred to as inducement. But what's actually happened when one of these patterns fails is that there's some kind of structure or point of interest in the area that is the real area that price is looking to move to and react from. So if you're new to trading and you can't understand why your chart pattern cheat sheet that you've downloaded from some random place isn't working, well, I'm going to show you why right now. So let's hop onto a chart and let's take a look at some real examples. Okay, guys, so here is actually a trade that I posted about in my previous video, I believe. It was my video on flip zones. So I've got the same area, and I can show you now, based on liquidity, how we could have potentially enhanced that trade. So we're in an uptrend, okay, we're coming up. We've had a pullback and an expansion, okay. After an expansion, we expect a pullback, okay, which we get, and that was where I had a trade idea that I talked about in my previous video. What I want you to notice here, we're obviously in an uptrend, so we're expecting higher prices. But what we get here, for example, is we get a bunch of relatively equal highs being built up. And if you think about my trade, when price came down here, I was looking for a trade opportunity here coming up. And of course, we take liquidity into account, we can see that all of these relatively equal highs here could have been a nice confluence to add to the idea that price was going to bounce and come back up. But let's take away those for now. So what's happened in here? Well, we've got the expansion and then we've got the pullback, okay? We've gone external to internal liquidity, and then we've come back out again to external, and we've come back into internal in the form of this inverse fair value gap here, okay, which was created when this candle closed, and then we came up and we reused it, and then we went up again to external liquidity. And then we're expecting what? Well, we're expecting now, and this is where our context comes in, if we've taken more external liquidity in the form of, say, this high, then we may be pushing down back towards some internal liquidity, right? Now, where would that be? Well, this fair value gap is resting right here, and we have our order block as well, which we've tapped, but we haven't gone into anywhere near even the 50% of this order block, okay? These down closed candles that then got broken. Okay? We haven't gone anywhere near the 50% of that, and we haven't gone anywhere near the 50% of the fair value gap either until now. So we could easily start to say that even though we're in an uptrend, we could be getting a pullback down into this previous zone, down into this fair value gap, the 4-hour fair value gap. And what else can we say? Well, up here on the left side of the chart, we have all this untapped inverse fair value gap and bearish fair value gap. So if we to extend those out over price, then we can see that we tapped into those and we got pushed down. So we've got a lot of context here, right? We've got liquidity here in the form of fair value gaps. We've got the external liquidity being taken above these highs. And then we've got internal liquidity resting below here. But what have we got in context of what we just talked about on our diagrams? Well, here you can see probably that we have trend line liquidity, right? Now let me go over to the 1-hour chart, because I think on the 1-hour chart it's even more clear. Can you see these lows here? Let me draw them out in a different way. We draw them out like this. So you can see all these lows here that have been made, these failure swings, right? The highs have failed to make a new low, and then we've pushed up and we've broken structure and so on and so on. So all of these are failure swings. So when we're looking at all this context that we have, we add the liquidity into it, we've got a good reason to target or to go back down into here and take out all these lows, right? Makes sense. Does to me anyway. So let me just show you now something a little bit retail-y. Let's go back to the 4-hour because it's a little bit less candles to deal with. So if we say, take out a retail concept, okay, let's say a breakout, right? If we think, all these are just wicks, right? There's a lot of wicks going on here, but not really anything breaking out. But look here. Here we have a nice, strong bullish candle closing above all this nonsense here, all this mess. And maybe that induces people into thinking, right, this is it. We're breaking out. We're going higher, right? Because they'd be right. In the context of the chart, even if they hadn't considered the context of the chart, the context of the chart is saying that we're bullish for now. But that's from the market structure perspective. So if you're just taking a breakout because these got broken, well, then maybe you need to rethink what you're doing. But yes, you could say, all right, you know, you're getting a breakout if you'd based it on market structure. Okay. Then you'd have a bit more context. But some people will just look at this as a breakout because there's a fat candle that's closed above stuff. But look at the context. Yes, we're bullish, but where are we going? We're going into all this liquidity that's untapped, all this bearish liquidity untapped. So are we likely to just smash through it? We could, but there's a good chance that we might see some sort of reaction, right? So don't enter a breakout here, because this is basically just an inducement, because then price is going to push down to seek out this internal liquidity, right? So you've been induced. If you take a breakout trade here, you've been induced into the wrong direction, basically, of the market. You're thinking it's going to go up, and you're right, it is going up, but not yet, because it needs to come down first and take out this, and then it's going to go up. Okay. Now, what about if you see this as a wedge, right? I think this is the tool here. Let's see how to use this. I don't use this. There. Okay. Yep. So there's a wedge pattern, right? A rising wedge. What is a rising wedge? It's a bearish pattern generally in, you know, retail technical analysis. So again, are you just going to take a trade? Let me extend it out a bit so you can see better. Are you just going to take a trade when one side of this wedge breaks? You're going to take a trade in that direction? No, you're not. You shouldn't. Okay, because yes, you absolutely could have got probably a half decent trade out of this candle if you went down to the 5-minute chart. But are we bearish? Are we going to base our entire analysis of being bearish on if we break out of a wedge? No, please don't do that. Okay. Now, could you have used this wedge here? Maybe. I mean, but then, you know, why not use all these concepts of the liquidity being built up and, you know, looking for that to be taken, the fact that we've got this big fair value gap sitting here that we're likely to go into, the fact that we're rejecting out of these previous bearish fair value gaps, and the fact that we had a short pullback here, and, you know, after we broke structure, we had an expansion and we got a short pullback. I took a trade out of that because I was pretty confident in all the confluence. You can look at that video to see why. But would I then want to take these? You know, I've got nothing here. Nothing that I would value too much except an inverse fair value gap maybe, and the fact that we're bullish overall. But, you know, this is so much confluence in this, right? So yeah, okay, if you've taken a breakout of this wedge to go bearish, well, if you'd done that on the 4-hour chart, are you going to wait for a candle close outside? Most people would, right? I mean, if you didn't wait for a candle close outside, you'd have taken all these wicks on the previous breaks, right? Because when this low got broken, if you'd drawn your wedge pattern on here, you'd have broken out there, you'd have broken out here. So you've got to wait for a close, right? I would say most people would wait for a close. So let's say you're on a 4-hour chart, you wait for a close outside. All this candle closed outside. Look at it, it's huge. Look at all that momentum. It must be going down, right? Because the wedge pattern says that it's going down. No. Think, guys. If you're doing this, and I hope if you're watching this series that you're not doing this because you've already learned better, but if you are doing that, you've got to rethink what you're doing. You've got to add other stuff in. The only reason we're going down here is to take out all this trendline liquidity, all this low resistance liquidity, and take out the liquidity that's inside this internal bullish fair value gap. And then we're following the context of the market, which is bullish, and we're going to go back up. So if you wait for a close here and you say, right, I'm getting in short now. Now this candle's closed bearish, we're definitely going short, and then you just get destroyed. So liquidity can show you some of this, right? It can show you why it's going here. It's going here to take this trendline liquidity, low resistance liquidity, plus this internal fair value gap, because it's taken the external, it's going to the internal, and then it's going to take the external again. I hope that's clear, and I hope that you can see that by adding all this together, you can frame a much better and safer context about things. So we can see that if we carefully analyze the market, as we have been doing in this video series so far, we're less likely to fall victim to these kind of inducements, because there's an inducement breaking out to the upside and there's an inducement breaking out to the downside. And hopefully then, by doing all this analysis, we can potentially look at these inducements and see where they're likely to form an inducement, and then we can take advantage of these. okay? Because we're not just operating on some random chart pattern that has no other context. We're adding a lot more context into stuff, so we can then identify why this might be an inducement, because we can see where it's going and why. Okay, and that's the important thing I think you can take away from liquidity concepts, is that they can give you an extra tool to say why did this happen. So we've already looked in this series about closures, or what some people call displacement, which is when we close outside of a zone or an area, as opposed to when we just wick a zone. So here, for example, we closed above these previous highs, so then we have some strength in the move that hopefully this is the continuation of the uptrend, and we're probably going to receive some sort of pullback now and then expand further. Okay, if we just wicked above here, then we wouldn't count that as any sort of breaker structure or a continuation of the trend, because it's just a wick. Okay? I think we're quite clear on those concepts. So where you see liquidity being swept here, you know, are we now, when we get above here, are we now saying that we're going bullish from here? No, you know, it's just a sweep. I mean, this would be better. I can understand why some people might take that as a breakout trade, but again, with all the context, it's not. So pullbacks, you know, pullbacks are basically the market's way of just rebalancing things and pulling back to seek out some liquidity. Okay, you can see that in both of these examples. Here, I actually took a trade, I think, in one of my videos that I did. So you can go back to that. I think it's number 7, maybe, the one about real trade examples. I think this is my example there where I took a trade. But we can see that we pulled back into this imbalance here, this gap, into this inverse fair value gap, and we just wicked it. Okay, you can see that there, I think. Just wicked it, and then we came back up again. Okay, so we can see that we're rejecting out of there and we're heading higher. Same thing here. We came down, we've come into this zone, we can't close below it, and we push up to go higher. The pullbacks are often just rebalancing or seeking liquidity, right? But don't always assume that liquidity needs to be swept or needs to be sought out. The price can just, you know, go and do what it wants. So nothing's perfect, okay? Now, one last thing we can talk about with liquidity is key levels. So key levels are also a great area that price might be drawn to, and that it may also react from. So examples of key levels are things like previous days' highs and lows, previous weeks or months' highs and lows, and midnight opening time, and I'm talking about New York time here, midnight open, so, you know, 12 o'clock at night, and that's what some people call true day open. And of course, there's also session highs and lows, and session highs and lows basically means if we see the Asian session, which forms between certain times, and then we come into, say, London session, what you'll often see with Asian session is that it's quite often a consolidation of some sort. And then what you'll get is that London will come and sweep either side of that, and then you might get a move based on that sweep, just like previous examples where we looked at the relative equal highs and lows. London might sweep above the Asian session and then go in the opposite direction. So it sweeps out all the liquidity resting above and then goes down, for example. So it can go over sessions, days, months, weeks, whatever. All these key levels are places where liquidity can be resting and where it can be sought out by the market. And I think really that's all we need to say about liquidity right now. There's other concepts that we can cover, but I think this video will go too long if I start now going into too many more examples of things. So let's just leave it there. But go away, study this, and, you know, have a look for examples on your own charts and use those first diagrams that we looked at to sort of reference where this liquidity might be resting, where it might be sought out, and where it might react from. Okay, guys, hope that's been useful. If it has, do the usual stuff, like, subscribe, all that stuff. Hope to see you in the next video. Take care. Thanks for watching.